What's going on, guys? So we're going to start off by talking about market structure, and we're going to talk about the basics, and then we're going to get into the nitty gritty as we go along. But obviously we're going to build up the foundation, as I already talked to you guys about, and then we're going to obviously build up on some of these concepts. So let's go ahead and start. So market structure 101. Market structure is the foundation to the markets. It will ultimately guide you to look for trades that are in alignment with where the market wants to go. Making sure you have a solid understanding of market structure will allow the transition to learning about later concepts that much more smooth. So market structure is pretty much like higher highs, higher lows. Is the market bullish? Is the market bearish? Are we consolidating? It's essentially kind of the roadmap when we're looking at the charts and how we want to approach a specific bias or how we want to approach a specific trade idea. So I'm going to keep it simple as I always do. The market will ultimately just move in three directions. It's either going to go up, down, or sideways. That's it. It can't do anything else outside of those three things. Now, understanding what market environment we are in, it's important because it tells us what steps we should be focused on. And we're going to start off with talking about bullish markets. Now, bullish markets are composed of higher highs and higher lows. Very rudimentary, it's very basic, but yeah, that's really what a bullish market is. A higher low is a low that creates a new high. And this, you guys really want to make a note of this because this is a lot of what I do in determining potential targets and looking for where the market wants to go to next. So definitely make a note of that. A higher low is a low that creates a new high. So in order for a higher low to be solidified, it must create a new low. It must create a new high. So that's something very important. And obviously I'm going to show you guys illustrations of this in the next few slides. In bullish markets, we typically look for price retracements down to support levels to look for buying opportunities. The main focus in this type of market is looking for a buy point at support that will ultimately be the next higher high. So here's a good illustration of this. So you see how the market had a push up, the market made a high. Now at this current time when the market made a low right here, this low is not a higher low until this high is breached. So once we get this impulse move up, now this becomes a higher low, this becomes a higher high, and same thing here. So this is just a good solid illustration of a bullish market structure. And I pulled up a chart here, and again the time frame doesn't matter because this could be any time frame, whatever time frame it is, it's still the same concept. So we have price in the consolidation, finally breaks out, price makes a low, and then this low is the last low, the lowest point prior to the new high. This low right here is the last low before a new high, and you guys see the point of all this. So this is just good because now we can use this as a framework of understanding, all right, if we're in a bullish market, we're focused on primarily buy positions, and we can look to take profits, let's say at the next higher high point. Now, bearish markets. Bearish markets are composed of lower lows and lower highs. So a lower high is a high that creates a new low. Again, this is going to be very important for determining potential target levels for our trades. In bearish markets, we typically look for price retracements into resistance for selling opportunities. So it's just inverse of what we were talking about for bullish markets. The main focus in this type of market is looking for a sell point at resistance. That will ultimately be the next lower low. So we're just anticipating the market potentially forming a lower low once we, let's say, have a decent size retracement into some sort of resistance. Now, I am going to cover all the resistance points and what levels we want to see in terms of a retracement as we get along in the market structure portion of the academy. And here is an illustration for you guys. The market makes a impulse move lower. Now we made a low, the market retraces. Now this high obviously doesn't breach a prior high, so as we break a new low, this becomes our lower high point, and same concept is shown here. And again, here's a good illustration of the market in a downtrend where the market makes a high down to a low. This high is lower than this one, makes the new low right there. There's a low point right here before we make a solid retracement, and the market makes a lower low. Now the last one is consolidation market. So simply put, consolidation market is when the market is just moving up and down. There's really no trend. A lot of people call it chop. That's another way to kind of phrase it. These conditions are typically ideal for reversal trading at the range highs and lows, and this type of market condition is best to take profit aggressively. So you don't necessarily want to hold trades For a big target, when there is a consolidating market, you typically want to wait for the consolidation to be over, and then you can look for the trend continuation. So here's a good illustration of what I meant with you want to look for reversals at range highs and lows. So when the market is, let's say, in this consolidation, once the market goes up to a range high, we can look for a reversal pattern to look it back, to take a short back into the range. And inversely, if the market is at a, let's say, range low, we can look for a potential reversal setup back up inside of the range. This type of environment a lot of people don't like, but you can still trade this. You just have to make sure that you're understanding what market condition you're in and have the proper trading setups accordingly. You don't want to look for continuation plays inside of consolidation. You want to look more so for reversals at the bottom end of the range and the high end of the range. So here's just a good example of a consolidating market right here, where the market is just as soon as it makes a new high, reverses. As soon as it makes a new low, it reverses. As soon as the market takes out highs right here, like this example, market reverses. This is just a good illustration of why sometimes consolidating markets can be tough, because sometimes people may anticipate, let's say, a trend continuation, and then they'll buy a dip, and then this is the dip that they get. So it's better off to just kind of focus on when the market goes up to range highs, look for setups at the top end of the range and buy setups at the low end of the range. Now, obviously a consolidation will break out at some point. So at some point you will probably have a losing trade looking for a reversal, but there are times when you can anticipate a range breakout, which we will talk about in the next few slides. So guys, this is it for the introduction to market structure. Now we are going to get into the advanced market structure concepts in the next PowerPoint.